We're going to jump to Bob's discussion here, weekly versus monthly, selling the premium against the leaps. Now, we had mentioned Bob's approach, but his full question that he sent to me via email today was, as one of my income strategies, I purchased long-term leaps on stocks, ETFs, and indexes. I'm assuming he's mainly doing calls. We didn't verify that, but I'm assuming we're doing poor man's covered call types approach. I have typically sold. That's supposed to be sold. I'm sorry. It was I verified that, of course, with him, but I forgot to do it here at the last minute. So we have typically sold weekly options against those positions and rolled them out to the Friday or last trading day of the following week based on their in the money, out of the money probability, and my view on the shorter term 1 to 2 week price direction for the underlying. So we have a leap call that's far out in time, which would of course just be a standard long call profit and loss chart. But we're selling weekly against that, so we create the calendar spread position, and he's continuing to roll these positions as the stock moves up or down, rolling to different strikes of the sold call or sold put against the structure. The objective is obviously to maximize theta decay. Same thing that Fernando just mentioned, selling those nearer terms at or slightly out of the money calls to get the theta decay and get as much premium. Bob's question is, with that as the basis, what is your view of trading weekly versus monthly expirations, or every 2 or 3 week options for that matter, with the pluses and minuses for each? Your thoughts on the question of rollover timing and frequency would be appreciated. Okay, now, in general, as we know, weeklies will always offer a higher annualized return. Meaning if I'm looking at a 1 week out option right at the money strike, for 5 days, 7 days, let's say 7 days of trading on, let's say, Apple, the premium might be $1. The standard monthly expiration or 4 weeks out is not going to be $4 at the same strike. It's going to be $3.25, maybe $3.50. In theory, you always get a better annualized return selling week by week by week more than month by month by month. Just as the same as you'll always see a higher annualized return on a position selling month by month by month, rather than selling 6 months at a time and hoping to just do 2 cycles over the course of the year. The option that 6 months at a time will be more expensive, but it won't be 6 times the cost of the monthly. And very rarely do you see positions where the monthly option is higher than the 4 week out option, I should say, Bob, is 4 times the price of a near-term weekly 1 or 2 weeks out. The time that does happen is coming up soon with the earnings season. So the next, if I have a stock that has earnings coming out in 3 weeks, the near-term 1 week out and 2 week out weekly options are going to be fairly priced. The 3rd and 4th week out, the 4th week out is probably going to be closer to 4 times or maybe even 5 times the near-term weekly, simply because the increased IV due to the earnings event. But in this market, we have seen different things. We just talked about it briefly before I jump into this. The gentleman in May 27th or May 25th, who had told me that he was having success in the last 5-6 months in the market using the monthly naked put positions on power options, the picks of the day and the standard monthly naked put screens, and I scratched my head. And then I saw that he was averaging a little bit more than 1% per month. That's pretty good for a neutral to bullish strategy on a market that's been declining 15, 18, 20%. So what I did is, and during his discussion, I also went back and ran that test for the monthlies to see what he would have gotten following the default searches, Bob. But then I also did the weeklies over the same time period, and they were actually at a loss. And I think that was the problem. Now, I can't do a quick backtest search while I was working on the other slides. I was doing this backtesting in the background. I can't do it on a calendar spread. We don't have that available in our system there for the strategy optimization for diagonal call spread. So what I did is created a simple covered call screen. Just looking for 1 strike out of the money on Apple. That's a reasonable range you might use to sell a call in a diagonal calendar spread, 1 to 2% out of the money, leaving some upside room, but still trying to maximize the ATM at the money bell curve premium. The option that's right at the money closest to the current stock price, of course, will always have the highest time value, not the highest price, but the highest time value. That's the at the money bell curve. So from January 3rd, 2022, I didn't go back to December here, just the start of January 2022 to today, roughly 6 months or so. We started out with a cash on hand of $35,000, and we ran just the one strike out of the money covered call for Apple for every week over this 6-month, 7-month time period. This is not a diagonal, but what it's showing you is that if you bought the stock at different times and hedged it with a weekly covered call that was just out of the money, with the fluctuations in the stock, which would also have a fluctuation on your leap option that's out to January or January 2024, wherever it is, Bob. The ending cash on hand was $32,083. So it was a loss of 8.3%. It was only a 43% success rate with a covered call, meaning the just out of the money covered call strike, which might have been the strike you were looking at to use. I know it's not the exact comparison, but we're going to get to that in a moment. So yeah, one trade every week for 7 months, roughly, 4 weeks in a month, maybe some in 5. So there are 28 total trades that make sense, but only 12 were successful and 16 ended up losses. Now, what does a loss mean? A loss means that you would have gotten the full decay on those 16 positions, the full theta decay you wanted on those positions. And you would have had to manage 12 to roll up and out in time on those positions because they were in the money. So it is slightly different. But with the fluctuations of the stock, this portfolio would have been down 8.3% just doing covered calls in Apple. Again, we would prefer to do covered calls in the money for better protection. This is just an out of the money example that we would use for the diagonal calendar spread idea. Well, the average premium on your 12 winners, or the 12 positions, 1.8, and the average on the losses was 2.2% with a decline in the stock. Now, this doesn't really relate to your calendar spread question. I'm going to have to do a different test on that, Bob, but what is interesting is I did the exact same test. But instead of doing the weekly series, we just did the monthly. So I'm sorry, I forgot to copy. I was rushed. I was doing this at 4:23, copying this over. Same date range, 6-month period. Started out with $35,000, ended at $35,882 with a return of 2.5%. The success rate was reversed. That's what I forgot to do. It was 16 winners. I'm sorry, not 16 winners. It was the 6 trades. So it was the 4 winners and 2 losses is what it was. Okay. I think it was either 5 and 3. No, I'm sorry. My apologies. Either 5 and 2 or 4 and 2. I think it was 4 and 2. But in any case, I would normally always say, and Ernie would say the same thing if you had him on a coaching session, Bob. The weeklies are preferred because you get a better annualized return. Some people, such as Chuck, probably like the weeklies because it's less time for the stock to move against you. You only have 4 or 5 days instead of 25 or 30. That's the advantage of the weeklies. So your weeklies, your W's here, your pros that you had mentioned is less time to move against you. As Fernando mentioned, these closer ones in, you'll probably see more of that rapid theta decay percentage-wise, which is what you want. So it's less time to move against you, better theta decay in that case, and you should get a better annualized return. Why are we not seeing that? And I feel it's because of the market conditions, similar to what we saw with that weekly covered call and naked put test against the monthly. And this type of uncertain market, I think the monthly premium that's higher, it's not 4 times the weekly, but it is giving you more of a cushion and more of a premium. At the same time, let me go back here. Let me pause the screen and run back real quick. My apologies there. Is this? Okay, yeah. No, I'm sorry. 1 second, folks. Apologies. There we go. That's what I wanted. Let me go back to this, folks. Okay. So earlier in the presentation, we were talking about with the market. So let's just say on January 3rd, I sold a 1 week out call. What would have expired? And then all of these would have expired here. They're doing pretty good. And then, of course, you would have to roll here for a weekly. That's fine. That's all well and good. But if I went in January 3rd and I sold a monthly here that was at $4. Let's say $4 instead of the weekly that was at $150. So I'm not 4 times the price. I'm sorry, let's just say weekly here was maybe, let's call it 1. And let's say 3 weeks out, this was at not 3 times the cost. I'm sorry, I did that wrong. Let's say it was at $250. But for this decline, I get the dollar here and it decays, and maybe I get 80 cents here and then it decays. I got $1.80, and maybe I get another 80, so I'm at 260 or 275. Okay, you're still taking the same premium. But this money here is more of a cushion. And then, okay, I sell the other one out here. So even though it's down, I got more premium, so I might not be at a loss yet. Whereas if I sell this weekly, okay, it decays. I sell this weekly, it decays. But remember, I'm taking in shorter premium here, 75 cents, 80 cents, depending on how far you go. So you start to feel these losses more. These sudden movements that are happening over a 2 or 3 day period. This one especially. So if you had sold a weekly, say here, and got 75 cents, this loss hurt. Yes, this is SPX, SPY. You probably wouldn't have been in this, I know, but I'm just using it as an example. Whereas over here, when I hit standard expiration, if I sold the standard expiration here and got $3, this might not have hurt so much because of the higher premium. And then we can still sustain through this time period. I haven't done the full test on this, as you can tell, Bob, but I'm not just for you, but I mean in general. But this is what I've seen twice now that has been interesting to me. That the monthly series, because of the higher premium, because of the quick fluctuations that are happening week by week, it's seeming to come out a little bit ahead over using the standard weekly positions. Now, Chuck probably won't agree with that. Chuck's doing better with what he wants using the tools he has for a specific type of credit spread. I'm just noticing that with the weekly covered call premiums versus the monthly covered calls and the weekly naked puts, you're seeing more losses on the weeklies because the sudden moves happen 1 or 2 quick days, which will wipe out that trade where you collected a smaller premium, even though it was only a 4 or 5 day trade. Whereas the monthly, yes, you didn't get 4 times the amount, you didn't get 3 times the amount maybe, but you got a higher premium that is acting as more of a cushion and can be ridden out with these sudden quick jumps that are happening. Now, when you have a sudden quick jump in expiration, of course, that just blows everything out of the water. Neither the weekly nor the monthly is going to be happy. But again, so far, that's what I've been seeing. My approach, as you know, Bob, when we were doing the bull put credit spreads, when I was talking about the bull put credit spreads, the weekly bull put default search we have in Power Options is my go-to in the right market conditions, which we have not been in for that strategy. That particular approach, okay? Just the static bull puts, which usually had an 86, 87% success rate, looking at for an average of about 14.5, 14.9% return on the winners, and keeping the losses to about 48, 49%, and only losing 12 to 15% of the time. When I did all my testing on that, for whatever reason it was, with market conditions from 2015 up to 2018, and then again from a test from 2019 to 2021, for whatever reason, using the same types of stops percentage-wise against the premium collected, it seemed the 2-week out series worked best. I saw the reasons why, and it was like I explained. When I was doing that extensive testing for the bull puts to find out what I wanted and then kept trading it and then kept modifying it to where I was really happy with what I was doing with it in the right market conditions. There's no one strategy that works in all markets, and as you saw earlier, I haven't touched those in a while. But for some reason, the 2 weeks out looked really good, and Ernie would tell you the same thing. If you're doing diagonal calendar spreads of this type, doing covered calls, selling premium against a holding, he would suggest 1 to 2 weeks out, shorter term, less time for it to move against you. I tend to lead to the 2 weeks out, 14 days personally, for the credit spreads, even selling a call against my married put positions, which is similar to what you're doing with the calendar spread. I like the 2 weeks for a little bit of premium, but yes, I do have to cross a weekend where I have no control over anything, and it could open down Monday or it could gap up Monday, I don't know, but I've already agreed to myself that I'm happy with the position if it suddenly spikes up or suddenly spikes down. So, but I wanted to share this with you because I'm going to run some more tests, but it was interesting that just doing covered calls, 1 strike out of the money on Apple, the weeklies from January 3rd to July 15th were an 8.3% loss with the position. Now, this doesn't include rolling, of course, Bob. This is just saying, hey, we entered a weekly covered call. If it gets assigned, great, we make the return. If it's below it, we close the stock and take the loss and then open the new weekly out of the money call on Monday, and so on and so forth. But the monthlies actually showed a small profit, probably not hitting the target goals that we want for covered calls on Apple over a 6-month period, only a 2.5% return, but it's showing positive with the monthlies, where the weeklies just out of the money covered calls were showing a negative.